Guys, welcome to another video. Uh, in this video, we're gonna be talking about what exactly is coin bond or crypto bond. When they say, a certain cryptocurrency is looking out to bond some of its token or some of its coin, what does it mean? So we're going to be diving deep to really understand the advantages and what exactly this coin bond means. Okay, I think Binance bond their token some time ago. Okay, I think it gave it some value some time ago. I think that. So let's read through. Coin bonding is a concept unique to cryptocurrency market. They are all, cryptocurrency in the cryptocurrency market. Many coins they bond them just to it happens a lot in the crypto market. So though it may sound hardcore, but coin bonding is a central mechanism that could prove to be a popular future, like we said, in the cryptocurrency market. Now, the many initial coin offering, which is the ICOs, they have integrated a coin bonding mechanism for unsold token at the end of their token sale. Now, many initial coin offerings have integrated a coin bonding mechanism for unsold token at the end of their token sale. Does this make sense? After the initial coin offerings, they will burn some of the coins that have not been sold. Like we said the other time, uh, initial coin offering is like giving awareness to the public and selling the token like cheaper, because the token basically is just new in the market and it doesn't really have value. So like you're just selling it like, oh, I have this token, and it's like you are raising funds through the initial coin offering to like give people awareness also about your token and your project. So once they have once they have interest because of how good your project might seem, so they buy into your coin. So now maybe you have 2 million or 2 billion coin total coin supply, and you find out that after the initial coin offering, because there is a period in which you start the initial coin offering, you end, or you can start again and end, because you want to raise a particular amount of money. Okay, you can raise above, it's fine, but you want to raise a range of an amount of cash. Okay, so now once now maybe your coin now is not all, people or the public didn't buy it all. Okay, they didn't buy as you felt or planned. So uh, we are now believing that because of this, many of these projects they come to bond their coin, their token. They later on go ahead and use the bonding mechanism to bond their token on those tokens that wasn't sold in the awareness campaign. I think that is a nice way to put the ICU. So not only that, but major exchanges with their own native token really adopt this bonding mechanism. Like Binance, I said that Binance really have been bonding their token for almost a while, almost all the time. Okay, so the bonding mechanism is really is rampant in the crypto space. Now, do you want to earn this money from cryptocurrency? To me, of course. So, well, if we want to make, let's buy some cryptocurrency that keeps burning themselves. Okay, what am I trying to say here? When the cryptocurrency keep burning themselves, they end up, you seeing that cryptocurrency or that token ending up having more value. Okay, we'll be talking. I wanted not to talk about that, but as we go, we'll be understanding more of this burning process or mechanism. Now, burning in another way is another way of earning from cryptocurrency. One of the most popular uh, ways crypto projects carry out burn is to buy a certain amount of token from the market to get it out of circulation. Now remember the example we give. Let's say you have a 1 billion total amount of crypto in the circulation. Okay, because you sold let's say 1 million out of that 1 billion, and you don't want the rest of the tokens, or you don't want the rest of the coins to just be there, and you want your project to gain value, I mean your token to gain value. So it says now the project, okay, the crypto project or the token carry out a bond to buy a certain amount of tokens from the market. Okay, this bond now you are buying it out of the market. You are taking it out of the circulation, meaning you are taking, let's say, out of that 1 million token that was bought, the rest of the tokens you want to take them out of circulation. So you are taking uh, the rest token that is remaining out of the circulation. You are buying it out of circulation. Now these tokens are then transferred into a frozen private address called a bond address. You see the bonding mechanism, what it really means. When it's taken out of circulation, it's as if someone is buying those tokens, but uh, 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 but really no one is actually buying those token. It is called this mechanism, this bonding mechanism. Now it is now being transferred to a frozen, or like, if yeah, a frozen, that's the way we can just put it, an adamant stagnant address, private address, okay, that is secured also. Okay, now it is one way address with no ability to reverse the transaction or withdraw the coin. This is massive. Don't you? I hope you're getting. So you see that many cryptocurrency, they come up with, they have so much. I've seen there's this cryptocurrency called what's it called? I've forgotten this. I've forgotten the name, but it came up with like a trillion, a trillion, a trillion token up. Like I was like, why would you come up with a trillion token? What's going on? And the project, the project, they said they are going to burn some coins at as they are going with the project. So you see that when you burn the coin, when you buy off the token from the market or the circulation, then you are putting it in somewhere that you can neither withdraw it nor send it out to anyone. So that place is called a burning address, or a burning wallet, or a burning uh, 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 a crypto bond platform. Okay, now the bond address to which the token is sent can be recovered, because there is no private key corresponding. It can't be recovered. What did I say? The bond address to which the token can set can't can never, yeah, it can't be recovered. Okay, can never be recovered, because yeah, you see, you can't, like I said earlier. So but all practical purposes, the asset no longer exists. It has been burned, and that is coin burning. Okay, you are intentionally taking a certain amount of cryptocurrency off your project, off your token, off your cryptocurrency that you have created. Okay, that is what is called coin bond. Okay, I wanted us to go more in depth. uh BNB did that, but I wanted to there was this. Okay, Ripple also did the same thing. Ripple, this project is I don't like that project. Centralized, and we don't even know how is how 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 many coins are in circulation, and it come today, it is the coin in circulation, and it comes tomorrow, man, that coin is different. But I see people buying it also. So now it said even stable coins like USDT, GUSC, USDC, and HUSD have conducted burn over 2.8 billion. Okay, even stable coins also have effect in coin burning. Okay, mostly coin burning is not only about making or to allow the coin or crypto to gain value. I think we was talking about some of the benefits and some of the disadvantages in a bit. So this coin burn provides privacy of the reserves once funds are added or retired. Now, when there is a deposit in reserve, tokens are minted. The burning happens when coins are minted into reserve and into the so the burning happens when the coins minted into the reserve are withdrawn, regulating the circulating supply and keeping the balance stable. That is for the stable coin. Okay, this is for the stable coins. Okay, they want, because you find out that since cryptocurrency has the nature of fluctuation, volatility, it goes up, it comes down, it has no stable price. So for the coin to remain stable, there has to be a certain uh, things to be done. Okay, okay. Uh, Now this cryptocurrency burning is a kind of intentional thing. Crypto owners or project managers do. Okay, I think I have a diagram here that shows how this burning process really works. But let's read here what I said here. Now, burning large amounts of cryptocurrency token can have the effect of increasing the scarcity of token, okay, which makes the token gain value. As such, burning can be used as a way of controlling inflation. Okay, it's either it's either uh, I mean, the fact that it controls inflation means that it's basically having much value in the market than previously. So that is the essence of burning mostly. It is similar to stock repurchasing in the world of traditional finance. Now, whereby companies purchase shares of their own common stock to increase the scarcity, or you understand what I'm trying to say? Okay, yeah, I hope you understand. Yeah, but I think it's really clear. All these things we have been speaking or talking about is really clear. Now, potential value and shares already have held by investors. Now, coin burning, as suggests, is a process of intentional eliminating your own remaining coin that you think is too much to exist. Uh, okay, the coins by rendering it unusable. Okay, it's really easy to understand this coin burn. Okay, now this is done by sending, we talked about all this, and now I want us to look into this image here. Now look at the address of the it's a born public address, the address of the public born. Now this only has a public address, I mean public key, which you only send and receive money, right? In this public key address. Okay, in this public key address. So this makes it you know this makes it what how do I put it? It makes it irreversible. That's, you don't have a private key that you can use in logging in to take back your coins you have sent in here. Does that make sense? Let's say it's like a wallet address, but this wallet address only consists of you having a public key. Okay, when you send you must be a project, maybe the owner of the project or token before you can embark on this. But I want to make you understand what coin bond, because you'll be hearing this mostly because many projects after they have conducted their ICOs, after they have created their token, their product, they will want to bond their coin. So once a project is looking at the bond is going, know that the project's coin will gain value in just a GIF, and you should have to prepare yourself. And so when you hear all this, it doesn't seem like you are like a newbie in the whole stuff. So now I was curious to understand that why will anyone now burn his coin after creating? Why they didn't even create such a man later just want to burn? So let's let's say why do you want to create like $1 million a million token, and you want to burn 1,000 of it? Why not just create 1,000 or like 200,000 and all that? So there are many interesting reasons why crypto burning is vital. Okay, the most well known benefit is that it increases the value of the token or the coin. But let's take that's Stellar for example. Mentioned above is a good reference. Now the corresponding increase in the value of each repo unit demonstrate that token bond impact the price. Okay, we talked about it impacting the price of in the short term. Okay, there's another reason I talked about here. Uh, Now the constant burning, like the way BNB is doing, the constant burning keeps a steady value of token, uh, and also bet for a long-term price rise. Okay, uh, using metric from the same period and considering the same crash factor, the price has remained around this, that, that. This. Now, this is what BNB or Binance token, utility token is basically doing. Now, Binance basically almost sometimes and it bonds its token. Okay, I think this year Binance also bond a token, and it increased the value, or yeah, the value rose up to like, is it 500 or 400 uh per 400 per one 400 dollar in value of one BNB. Now I wanted to say something here about the constant and okay. I wanted to say, but I think I've forgotten what I wanted to say. Now, yep, yeah. These are all examples of the tokens that were born. But I think let's just take some of them. Now, Project S conducted a token bond. Afterwards, the supply reduced and the value of the token appreciated by 10%. Accordingly, this has made every community that hold that coin, okay, to have that 10% profit. And I think all these things we have just said it in just some few words. I'm making all this. Now, many projects even employ this as one of their marketing tactics. Okay, we see projects like I said, like I told you earlier about that project. That project is a we're going to be conducting a bond later on. Don't be frightened about this our supply, our total supply. Okay, so we're going to be bond some of the coins later on. So they are showing their coin holders or token holders that our coin is going to gain value once we do a bond. Okay, like marketing tactics. That's it. So now trust and confidence in the project is a key element. Now this is where the example during the ICO stage, like we talked about earlier, it's common to find burning process is done once the token or the coin is finally launched to provide new investors with the reliability that their funds will not be affected by over circulation. Over circulation, you know what it costs. I think when we are doing the investment course, we will talk more of what over circulation really is and why it's pretty bad. Okay, Now, additionally, by reducing circulation supply of a portion of the circulation of a cryptocurrency like the Ripple, as for example, uh, now the number of transactions get equally reduced. Okay, a reduction in volume lowers the chances of spam attack, and which leaves enormous bandwidth for healthy transaction count on the network. Now we looked at how crypto burning helps in reducing numbers of transactions, which helps in reducing attacks on the blockchain network. Now, coin burn in cryptocurrency, it basically now it's, I mean, we discussed about this, and I don't want to talk about it again, so that's why I just left it. So now this public address that they are sending, or the coin is supposed to be sent to in the crypto bond public address, should be available on the blockchain for everyone to review, like everyone that participated in that uh token sale, or like, look at how it is here now. Everyone has this address to go back and check on the network and see what has or actually happened, how many tokens were born, which day it was born. So this is the public address we're talking about. This thing here, this address is the public address we are talking about here. Okay, so this is it. Where are we? Okay, this is it. Now, Coinbond is done for a purpose, for making tokens to increase in value, and for rewarding the token holders. Okay. Now, I need to explain the proof of mechanism, proof of bond mechanism using uh, which coins are born in. Okay, I want us to just take a glance through it. Now, the proof of bond mechanism, the proof of bond mechanism, consensus mechanism, is a method for distributed consensus, an alternative to proof of work and proof of stake mechanism consensus. What is this trying to say? Now, you see, in Ethereum 2.0 has have this proof of stake mechanism. Bitcoin blockchain has this proof of work mechanism. Now, in this proof of stake, and I mean, Ethereum 2.0 have proof of stake consensus mechanism, and Bitcoin has the proof of work mechanism. Now, in this proof of bond mechanism, it is different from these two proof. Okay, now, it can also be used to bootstrap one cryptocurrency off another. Okay, now the idea is that miners and participants of this blockchain should prove that they bought some coins. Okay, now it's still the same thing. Miners in cryptocurrency, in Bitcoin, in the Bitcoin blockchain, miners there prove that your transaction is legit. Miners in Ethereum 2.0, 2.0 prove that, yeah, you actually staked your coin in their platform or in their network. Now, in this proof of bond, miners check that yes, this project actually bonds this coin here. Now, that is, they send them a verifiable, uh, verifiably unspendable address. Okay, this is expensive from an individual point of view, just like the proof of work, but it consumes no resources other than the bond underlining as asset or token or coin. I hope you get what I'm trying to say. Yeah, I believe so. Now, to date, all proof of bond cryptocurrency work by proving work by burning proof of work mined cryptocurrency. So the ultimate source of scarcity remains the proof of work mined fuel. And in some cases, you also get the special right of mining blocks and weight of the coins that you have burned. Now, think of it as a virtual mining setup for making new tokens or coins. Okay, think of it like that. Okay, the proof of bond mechanism. I think it is quite understandable now. Let me just take this and we're done. Now, the coin bond or the proof of coin bond has several applications depending on different scenario you want to use for it. Okay, now people or the projects participating in this coin bond or coin proof of proof of bond mechanism, consensus mechanism is a network on its own. That's one thing I want you to understand here. So they have different uh different what's it called, apps uh that still work on the same network. Okay, just to make sure the coin is really born. So miners are rewarded when they successfully burn a token, amount of token. I participate. Yeah, did I no? Did I do that? No. So uh, that is. I wanted us to see the advantages. Uh, we talk about the why would anyone burn coin to increase the value of that coin. uh, okay, to increase the value of the coin, like we said earlier. Now, to protect against spam, we talked about this, harmful, what's it called, harmful uh, transaction coming into the system. Now, to sign off long-term commitment. Now, combining is an effective tool to signal a firm committed. Now, this okay, let's read. I ordered. Now, the goal of any project is to add significant value to coin holders, who will probably be the core user and supporter of their service. This coin burning is to give the holders of the coin or token that yes, we are in for long term. We are going to take this project to another level. So they give a an assurance to coin holders that yes, we are in for long term. So we are not going. Many coins come into the game and they die. Okay, after some few years and they die. So some survive, some increase in value massively. So this is a one way to let the holders of the coin know that yes, we are in here for a long term. We want to be here for a long term. Okay, now one other this reason why coins are being born, uh, the categories of coin burning. Okay, categories of coin burning is basically to categorize. Coin burning can generally be classified into two uh, distinct categories: integrated at the protocol level and implemented as an economic policy. So I think this is just the category of. I think I should have, changed the headline here. Okay, now uh, let's just take this this for example. The process of burning or destroying coin, taking them out of circulation and making. Now you have the protocol. This is explaining what we're talking about here. Now we have the protocol level and we have the economic benefit. Okay, now the proof of burning consensus burns the coin, and spam protection mechanism is initiated. For the economic policies, the destruction of the unsold token is basically destroy uh, dividend to coin holders. It gives more interest, or like a rise in value to other coin holders. Okay, so I hope this is clear. Just that the categories are like is quite, but it's one of the benefits basically for burning a coin. It's just like a different perspective for the protocol perspective and the economic perspective. So